Hey again, Jason here. I had a great night last night. It was my birthday and I had a celebration. If you came and you're watching this video, thanks a lot for coming. It was lots of fun. So today I'm going to talk about two things. I'm going to talk about two key factors that you need to understand in order to properly analyze a company. And those two key factors are the financial position of the company or the financial strength of the company. Sorry about that. And also the quality of the earnings of the company. So in terms of the financial strength of the company, what you're really looking for is this the type of company that's likely to go bankrupt? That's the first and foremost thing that you're looking for. So basically, even if you invest in the best company, if it goes bankrupt, you still lose all your money. So this is more of a safety thing you're looking for. You want to make sure that the company isn't taking too much risk and that it has conservative financing. So how do you do this? In order to analyze this, you want to look at both qualitative and quantitative factors. So some of the qualitative factors you can look at are the management. I mean, is the management established? Have they been with the company a long time? Is it new management? Because different managers might structure the company financially than other managers would. So you want to make sure that the type of managers are in place that will make conservative financial decisions. In terms of quantitative factors, one of the most important variables is the debt to equity ratio. And that's basically how much debt does the company take on for every dollar of equity it has in the company. So the higher the debt, the riskier it becomes because you have to make those debt payments. So if you have a bad quarter, if you have a bad year, one bad year, if you have a lot of debt, could make the company go bankrupt. So in general, the lower the debt, the more conservatively financed the company is. And another important quantitative variable is the current assets to current liabilities. And there's many ratios to analyze this. But in general, you want a company that has more current assets than current liabilities. And the most important current asset is cash. You'll even find some instances where you can buy the company at a cheaper price than the cash reserves it has. This is rare. And this usually happens in times such as the Depression or in really big recessions where people are just really, really pessimistic and what they're doing just makes no sense at all. So cash is super important. If the company has a lot of cash and low current liabilities, that's a great sign of financial stability. And there are many, many other factors to look into. Right now, the important thing is just to understand this idea of the financial position of the company. And later on, I'll go more and more in depth of how to analyze this. So the second thing is quality of earnings. And basically what you're looking for is you want to find a company that has stable earnings and is likely to have stable earnings in the future. And as a bonus, growth potential is great. But a lot of times people look for growth before stability. And in my opinion, that's a mistake. What I do when I invest as a value investor is I look for stability, and then what I'm looking for is to buy a company at a cheaper price. And if there's a potential for growth, that's awesome. That's amazing. So in terms of the stability of earnings, one of the things that's really important is just what type of business is the business and what type of industry is it in. Because different industries by nature have different stability in their earnings. Technology companies in general have much more volatile earnings than, let's say, real estate companies, right? And in every industry there's always exceptions, but in general, you want to look at, is this a type of company that can have sustainable earnings? If you're investing in a startup tech company that's taking on a whole new type of endeavor, chances are those earnings aren't going to be very stable, and it's much, much harder to properly estimate what those earnings should be, and therefore what type of price you should pay for the company. What else? Oh yeah, and of course another way to look at the stability of earnings is just look at their past earnings. Have their past earnings been stable or have they been very, very volatile? And if they have been volatile, is it because of a one-off thing, or is this just the type of company that it is? And you wanna try to avoid companies that have very inconsistent earnings. And of course, there's many other ways to measure earnings. I'm not going to go through them all today. But it's the same thing as looking at the financial strength of the company. What you're looking at is both quantitative and qualitative factors in order to assess the earnings of the company. So now, since we've gotten that out of the way, I'm going to talk about Coca-Cola. All right, and Coca-Cola is an amazing company, all right? And, you know, last time I said Apple was an amazing company, Coca-Cola is also an amazing company. And Coca-Cola, unlike Apple, is the type of company that I would actually invest in. And the reason because of that is because they're conservatively financed, so they have a strong financial position. You know, actually, recently their debt has risen a bit more than I like, but it's okay. They're Coca-Cola. You know, they can kind of get away with that because they have such a strong brand, which is basically a protection around their financial position. You know, so Coca-Cola can take on a bit more debt. And the second reason, as opposed to Apple, is that Coca-Cola has very, very stable earnings, and their earnings are incredibly protected. You know, Coca-Cola doesn't have to come out with a revolutionary product in order to maintain their earnings, unlike Apple. You know, and for instance, there's a story of when Coca-Cola came out with a new Coke, and people actually hated it more than the old Coke. You know, and people are going to be drinking Coke for a long, long time. You know, right now there's a threat of, you know, the whole health movement, but even then, people are going to be drinking Coke for a long, long time. And the great thing is that even with these stable earnings, there's a lot of potential for growth because of emerging economies, which Coca-Cola is moving into. You know, so in conclusion, Coca-Cola is an amazing company. It meets the two criteria I look for, which is a strong financial position and stable earnings that are going to be consistent now and in the future. But I still wouldn't buy Coke. And here's the reason why. The reason why is because its price is too high. Okay, so so the first part you want to do is you want to find a company that's the type of company you want to buy. But the next step is you have to buy it at the right price. Because even if you buy the best company, if you buy it at the wrong price, you're going to lose money. You know? And in terms of this, you know, Coca-Cola's PE is 20. So for every dollar of earnings, you're paying $20. And to me, that's too much. You know, there's been times in the past when Coca-Cola's PE was around 10 or 11. You know, that if I would have saw that, then I would have said, yeah, it's time to buy now. You know, but right now their price is just too high for me. Although there is the potential, because of their potential growth in emerging economies, that their earnings could catch up with their price. That's very possible, and that's probably why it's kind of higher price right now, because a lot of people are probably thinking that. But personally, I think it's possible to find companies out there that are priced lower and with similar earnings and financial positions as Coca-Cola. So the opportunity cost isn't really worth it for me. So I wouldn't buy Coke, but keep an eye on Coke, because I'm sure one day it will be lower priced again, and that's the time to buy Coke. And as a little bonus today, I'm going to recommend a book that I actually haven't read yet. I just discovered, and it's called Principles by Ray Dalio. Principles by Ray Dalio. You can find it on the internet for free. I found it. And this book is written by Ray Dalio, who's a billionaire hedge fund manager, and it's all about the principles he finds for success and for management. So I think I'm going to read it probably this week, and I think it's going to be an amazing read, and I recommend, if anyone out there is interested in it, to read it too. And let me know what you think. Anyways, I hope today was informative. Have a great day. Bye.